Welcome, everybody, to the California Pollution Control Financing Authority and to today's Capital Access Loan Program Stakeholder Symposium. I am Reneé Webster-Hawkins, the Executive Director, and on behalf of our board, I welcome all participants to today's event, both in person and those participating via webinar. With me, from the hardest working team I've ever had the pleasure to work with, are somewhere around the room or in the background, Elena Miller, my Deputy Executive Director, Patricia Croson, CPCFA Operations Manager, Janie Davis, Strategic Development Manager, Doreen Smith and Bianca Smith, who are CalCAP co-managers, Jason Bradley, Electric Vehicle Charging Station Financing Program Manager. We have CalCAP analysts Isabel Becerra, Lauren Ross, Leandre Henry, Christina Vu, Robert Sauls, Eddie Crisson, and Jerome Washington, Angie Hernandez, and Lisa Johnson, and that team reviews every single one of our loan enrollments and claim applications personally. And then, certainly not least, on today's Administrative Professionals Day, our administrative team, which supports the entire authority, in addition to the CalCAP program, we have Laura Coulter, Ryan Mallory, Aaron Lorio Jimenez, and Gerardo Martin. We also have other CPCFA staff with us today that specialize in our bond and remediation programs, and I do want to say at the outset, in my years of public service, I've never found such a powerful, nimble team who can accomplish so much. First, we're going to briefly review today's agenda, and then we'll move right into the heart of the event. We've done the introduction. We'll go over a little bit of housekeeping. We'll review briefly the symposium objectives, and then I'll turn to introducing the members of our panel here today. After that, we'll be providing you some CalCAP program performance data, some proposal presentations will follow. They're the heart of our event today. Following that, which should take us right up to about 11:30, we'll have a 10-minute break. When we return, we'll present some recapture scenarios based on CalCAP's data sets. After that, we'll invite participant comments, finally panel member comments on what they've heard and what reflected on today, followed by the wrap-up. And we do expect this will take us right up to about 1 o'clock, depending on how talkative everyone is. So first, to address some housekeeping. We are fortunate enough to use this hearing room and teleconference equipment hosted by the State Personnel Board. For your convenience, restrooms are down the hall past the security station and to the right. There's also to the left are vending machines. In the event of emergency, please use either of the emergency exits, exit out of the building, cross Capitol Mall, and gather in the grassy median strip in the middle of Capitol Mall. Now, looking forward to the time for participant comment, we will facilitate it much like you would experience at a city council or a public board meeting. For those of you that are here in person, when you checked in, you should have been offered a participant comment card to fill out if you would like to speak during that time. Please be sure that you have done so, if not now, no later than the break, so that staff can identify how many people would like to speak. And please provide your card to Janie Davis, who's at the back of the room. Similarly, for those of you participating remotely, if you are at a computer with a microphone-enabled device, you will be able to offer your spoken comments today as well. Let us know that you would like to do so by entering the following information in the chat box in your GoToWebinar application: your name, your organization or affiliation, and which of the 5 topics in the scoping document you would like to speak about. And again, please provide that information to us through the chat feature before we take our break. For those of you on the webinar who are not at a microphone-enabled device, unfortunately, you will not be able to provide spoken comments today, but we welcome your written comments. At the break, based on the number of individuals indicating the desire to comment, we'll determine the number of minutes that each speaker will have. And depending on the number, we think each minute a person will have between 2 to 3 minutes to speak. Participants via webinar are welcome to use the chat box to send us any technical information or technical questions if you're having trouble with the platform. And as this is a symposium as opposed to a workshop or a roundtable, we won't be entertaining free-flow questions during the course of the event. Please save those for your comment at the end of the event. And then for your convenience and resource, a copy of this presentation and a recording of the webinar presentation will be posted on our web page later today, and a transcript of the event will be posted by next week. So moving briefly to the symposium objectives, the event announcement and scoping document has had a thorough explanation and background for why we are here today. To briefly encapsulate the need for today's conversation, everything we will be discussing today incorporates three principal dynamics associated with the CalCAP for small business and the heavy-duty truck loan program. We have had incredible program growth since the CalCAP program was first established in 1994. After steady volume for the first 15 years, the economic recession in 2008 drove up demand for the program from borrowers seeking capital under distressed economic conditions. CPCFA received three significant new sources of funding around 2010, including a $6 million appropriation from the State General Fund, a major allocation from the U.S. Treasury to expand our CalCAP for Small Business program, and the beginning of our Air Quality Improvement Program funding from the Air Resources Board to establish CalCAP purchase and retrofit of heavy-duty trucks. As the program grows, to ensure program efficiency and integrity, it begs the need for both the state and our participating financial institutions to remain ever diligent in applying sound lending and administrative practices. In the recent years, program volume, including both loan enrollments and claim applications, is accelerating dramatically in an upward curve. And even as we now are reaching the foreseeable end of the revenues in both programs. That is the principal driver of the timing of our symposium today, to implement a mechanism into CalCAP to ensure its sustainability to support future lending to small business borrowers throughout the state. At all times, in everything we do here at CPCFA, we are mindful of our duty to be active public stewards of taxpayer funding while ensuring the availability of our program to the widest number of small business owners. At the heart of CalCAP is the notion that by providing a credit enhancement to support private commercial lending, the small business sector can be sustained, can grow, and can create more jobs and economic opportunities for Californians. In the environment that we have just described of program growth and declining new resources, being good public stewards in large part means keeping an eye on the program integrity, operations, and accessibility to lenders and small business borrowers in all areas and industrial sectors of California. We have an incredible opportunity before us. This challenge presents a unique opportunity to establish a sustainable capital access program. When the U.S. Treasury allocated the State Small Business Credit Initiative funding in 2011, it required state administrators to build in mechanisms to ensure sustainability of the federal funding long after the first use of the monies. For states like California, with new or existing CAP programs, the U.S. Treasury allowed us to count the leverage from companion programs like collateral support, the loan guarantee program, and venture capital programs, and essentially kick the can down the road for our CAP programs. As staff announced yesterday for our CalCAP for Small Business program, the end of that road is now foreseeable, and we need to figure out how to refill that can if we are to continue to support the enrollment of new loans after this summer. In our research, we are not aware of any loss reserve program in the nation that has a recapture feature. There are a few that have a maximum allowable threshold in the loss reserve account, such as those that support energy efficiency retrofits. However, a built-in recycling mechanism may be the first of its kind. The U.S. Treasury is greatly interested in our leadership here in California on this issue and the prospect of developing a model for a sustainable capital access program. So this underscores why what we're doing here today is so important. The scoping document identified 5 concepts for CalCAP program improvement to increase program sustainability and participation, and sought input on these ideas from the CalCAP stakeholder community. To be clear, these ideas all came from you, from current and potential participating lenders, from funders, from legislators and other decision makers interested in CalCAP programs, and from small business organizations interested in maximizing the availability of or access to CalCAP funding. These 5 ideas have come from the stakeholder community that you collectively represent, including some of you in this room and on the webinar, as ways to extend the power of the CalCAP model. So in a nutshell, the 5 ideas are: number 1, a framework to implement the recapture of funds from existing loss reserve accounts to support ongoing program and administrative costs. Number 2, an option for a lender to elect to pool fees and contributions from all CalCAP programs that lender participates in into a single loss reserve account for that lender, unless a funding source would expressly prohibit it. 3, increasing the initial state contribution for new lenders to accelerate the initial buildup of a loss reserve account and incentivize new lender participation into the CalCAP programs. 4, the establishment of a reservation system to facilitate a lender's assurance of the availability of program funding. And 5, how to build in incentives for lenders to maintain default rates at or below the national average for small business lending. We note that not all of these ideas were addressed by either of the 2 presentations that we will hear from later this morning. We're interested in hearing from you, particularly those of you that have proposed any of these ideas to us in the past, whether they are worthy of further exploration or whether upon reflection you believe it may not be the right move at this time. So now I'd like to introduce our invited panel members. We have 6 colleagues we've invited here today to help us structure and digest the information in this symposium, and we are grateful for their time, their active interest, and their expertise to help us think through the challenge of establishing a sustainable CalCAP program. What I'm going to do is introduce each panel by describing them through a bio, and then give them each one a brief opportunity to say hello and offer a statement to us about why the CalCAP program is important to you and the stakeholders you represent. So first of all, I'll start with Mr. Tim Schaefer, Deputy Treasurer for Public Finance for the California Treasurer, John Chung. Prior to joining the Treasurer's office, Mr. Schaefer was then State Controller John Chung's senior finance advisor. Before entering state service, Tim was the principal owner of Magis Advisors, a public finance consulting firm in Orange County. Tim has more than 40 years of experience in the municipal securities industry. He managed the public finance division of Bank of America in San Francisco and was the manager of a national municipal trading desk at Chemical Bank in New York City. He served more than 20 years on the Technical Assistance Committee to the California Debt and Investment Advisory Commission, including 3 terms as chairman and 3 years as the private sector advisor to the Standing Committee on Governmental Debt of the Government Finance Officers Association. He is a co-author of the California Public Funds Investment Primer, published by CDAC in 2006. He was part of a 4-person team engaged in early 2014 to edit and revise that primer published by CDAC. He's a frequent speaker in the field of public finance and a member of the Risk Management Association, the International City-County Management Association, the National Federation of Municipal Analysts, and the government. Tim, welcome. And if you could offer us any thoughts about CalCAP and its role in public finance.
Thank you, Reneé, and thank you all for participating today, and thank you to fellow panelists. One of the challenging and exciting things I get to do in my job as a Deputy to State Treasurer John Chung is to put my fingers in a whole lot of different pies, and this happens to be one of them because I have a background, as Reneé is kind enough to explain. Some of you might interpret that as I couldn't hold on to a job very long. Others might suggest what I would like to suggest myself, and that is that I have a very eclectic background. But the one thing that I have focused very intently on at the Treasurer's urging is the fact that in a state like California, which of course has some significant challenges going forward simply because of its size with 39 million people, the fertility of a business culture that rewards invention and innovation has to be maintained. Part of the responsibility of good public stewards is to nurture those cultures so that people like me, who started a brand new small business with 4 employees, wait for the punchline now, in August of 2008, have the opportunity to flourish and prosper. The CalCAP program is a part of that ecosystem, and as such, to this treasurer and to others, it's one of the crown jewels of the office. So we encourage each of you to interact with us, offer us your unvarnished take on things, on how this might be improved, because this is not just some bureaucratic exercise. We truly are committed to better understanding this ecosystem and responding to it in a very positive way that will benefit all Californians.
Thank you, Tim. Next, Mr. David Haithcock, Executive Director of the California Community Banking Network, formerly the California Independent Bankers, the Executive Vice President of the Independent Community Bankers of America, based in Irvine. David was recruited to replace a retiring incumbent to serve a multifunctional role within California and the Western region. He has primary responsibility in serving as the Executive Director and Officer of the California Community Banking Network, CCBN, a statewide bank trade association, as well as Executive Vice President of the Independent Community Bankers of America, a nationally based Washington, D.C. bank trade association with over 5,000 member institutions across the U.S. David has over 20 years of association executive management experience, covering areas such as board and executive committee management, strategic planning, budget preparation and administration, policy development, legislative strategy, marketing and public relations, economic analysis and reporting, and research analysis. We welcome you to this event. Thank you, Mr. Haithcock. If you have any comments you'd like to make to open.
Yeah, I first want to start off by thanking you for allowing us to be a part of this and being very proactive in this topic. And I also want to commend you on the organization of putting this meeting together. We put on over 20 meetings a year, so I have a personal understanding of what it takes to get this all running. I was joking with Tim, a little side note, when I first started at 24, I came to this organization when I was 24, first out of college. And my first job was to put together this board packet, and we used to use those overheads. And the clear overhead, so it was simple, easy. You just have to print out, just put them in the copier and run it and go. Well, I had to edit the verbiage first. So I did that. Well, I first printed them out, and I didn't edit it. So I'm like, I just wasted this whole stack of these clear sheets. I edited it, did it. The first piece goes on to the overhead, and sure enough, it's the wrong set. And I have, a room full of community bank CEOs looking at me. I'm like, what are we doing with hiring this kid? So thank you for allowing us to be a part of this. I started off in this 94. I've seen a lot of cycles through the industry. Back then, it was commercial real estate was a challenge. And, for us, we've seen, probably for start off saying, 90% of my institutions are commercial lenders. That's their small business is what they do. We hold less than 20% of the assets, but make over 60% of small business loans. So it's really in our wheelhouse in this area. Since 2008, we've probably lost over 40% of our charters here in California. So we have those that have survived and are now, are getting through it. For us, we've always been, we've always had a good connection and good relationship with the Treasurer's Office, but more so now with this Treasurer than we ever have. I think he has a clear understanding and appreciation for what community banks serve in their communities and the role of having that public-private partnership. We are very big proponents of keeping our California's money local. We work very well with the pooled money investment account on the liability side. So now on the asset side, being able to lend it, we're still having that public-private partnership is perfect for our institutions. So I thank you for allowing us to be a part of this discussion and look forward to hearing more.
Thank you. All right. Next, we have Ms. Anne-Marie Rogers, Chief of the Compliance Assistance and Outreach Branch of the California Air Resources Board. Anne-Marie has more than 25 years of work experience with ARB. She has held the position of Chief of the Compliance Assistance and Outreach Branch since October of 2014. In this capacity, Anne-Marie oversees the development of coordinated stakeholder outreach and education for diesel regulations and incentive programs, including low-carbon transportation programs funded through the cap and trade funds. She's also responsible for the truck loan assistance program and the school bus cleanup projects that support state air quality and climate goals. Prior to her current position, Anne-Marie managed the Climate Action and Research Planning section in the Research Division at ARB. She oversaw the development of ARB's extramural research projects and developed programs that support climate-friendly practices from businesses, individuals, and local governments. Welcome, Anne-Marie.
Thank you, and I just want to say thank you, Reneé, to all your staff and everyone for letting us be here today so we can start working on this really important aspect. My name is Anne-Marie Rogers with the California Air Resources Board, and my group is responsible for the heavy-duty vehicle program, or the truck loan assistance program. As many of you know, the program is funded through Air Quality Improvement Program funds, and it's to help small business fleet owners affected by ARB's truck and bus regulation to secure financing for upgrading their fleets through new trucks and exhaust diesel retrofits. The program was launched in 2009 and is implemented in partnership with CPCFA. ARB's funds are used for loan loss reserve accounts, which enable lenders to issue loans to businesses who may not otherwise qualify for financing at reasonable terms. The program has been very popular, and ARB's been lucky enough to be able to meet the market demand over the last few years. As of January 2017, CARB's contributions of $84 million have enabled 12,800 loans. Almost 4,000 loans were issued in 2016, and we expect about 5,500 loans in 2017. To date, this program has solely relied on funding through independent contributions by CARB. Since its inception, Recapture funds has always been a CARB goal. But however, it was not built into the program when it was first introduced in 2009. Since the program is now well established, we believe it's appropriate to start looking at a recapture mechanism. The two actionable items for us today are really looking at how to establish a safe recapture mechanism and exploring borrower and lender fees. So I'm hoping today's presentations will shed light on those items. We think we have a good idea of what can be recaptured. There's potentially over $75 million that would accumulate in the loan loss reserve account by the end of fiscal year 21-22. So we're looking for a data-driven solution for possible, which would account for possible future economic downturns and also take into account the performance of lenders, so looking at volume of loans and the claim rates. We'd also like to look at the feasibility of introducing borrower and lender fees into the program. Ideally, the structure would not adversely affect the borrower or the lenders. So as you know, we have a lot of competing funding priorities. That's why it's important to look at how to make this program more self-sustaining so that we can continue to serve the large demand of our borrowers. Implementing a successful recapture component would set a really good example and be a great model for current and future state financing programs. So this effort is really important on many levels, and I look forward to working with all of you as we work to evolve the truck loan program.
Thank you, Anne-Marie. Next, we have Mr. Kevin Gould, Senior Vice President, State Government Relations, California Bankers Association. Kevin joined the CBA in 2004, bringing with him more than 7 years of legislative experience. In his role as Senior Vice President and Director of State Government Relations, he is a member of the Senior Management Team and oversees CBA's State Government Relations Department. and also serves as one of CBA's 3 registered lobbyists. Mr. Gould oversees CBA's State Government Relations Committee and internal policy committees who provide expertise and directives that guide the priorities of the association's state government advocacy program. Mr. Gould is a member of the 2009 graduating class of the Pacific Coast Banking School. Welcome, Kevin.
Thank you, Reneé. And I, too, as others have, want to thank you and your team for putting together this forum. It's a privilege for CBA to be able to participate. California Bankers Association has been a longtime supporter of CalCAP since its origination, and we've been very supportive of it as it's evolved throughout the years. And we want to see it continue to be successful. So I'm very much interested in listening and learning and figuring out how we can continue to work together on a go-forward basis. Thank you.
Thank you. Mr. Mike Daniel, Regional Director of the Orange County Inland Empire Small Business Development Center Network. Mike oversees a network with 7 service centers that cover the region that service more than 5,000 small business owners each year. He has been with the SBDC program for the past 6 years and also served as director of the Long Beach City College SBDC. Mike has personally assisted more than 1,000 clients in areas such as business startup, marketing, legal advice, funding opportunities, and more. Mike is also a small business owner owning Rocky Mountain chocolate factories. Did you bring samples? He has been part of the Rocky Mountain franchise system for more than 15 years. He is currently opening a new venture called, again, Sugar Daddy's Sweet Shop, which is another high-end candy store that will be located in Shoreline Village. As an entrepreneur, Mike has firsthand experience in systematizing operations, developing budgets, creating marketing programs, and managing employees. In addition to his role at SBDC, he's been teaching at Cypress College for the past 10 years, teaching computers, QuickBooks, PowerPoint, and Excel. Welcome, Mike.
Thank you very much, and thank you for having me here. I'm here to represent the California Small Business Development Center Network. So we actually are 6 different regions, and we have 3 other regions here today. Our purpose for being here is we see about 50,000 clients every year, small business clients. I would say half of those are looking for funding, and our role is to really kind of help them pre-package their loan, become ready to get lending, and then once they get the loan, to help them through the process. And I know one of the areas that we're going to cover is the default rate, and helping clients once they've actually received funding, how do they make sure they can pay it back? How do they grow their business rather than use the money for something that they shouldn't be? To date, last year we helped our clients access about a little over $100 million of capital, and a lot of these loans are very small loans, $10, $25, $50, $100,000. And what happens, unfortunately, is we have a lot of clients that are turned down from their primary banking source, which one of the big large banks, and they don't know where to go. And so they usually come to us, and this program is significant to us because it's another arm for a small business to actually receive funding. So thank you for having us, and yeah.
Thank you, Mike. And lastly, Mr. Jeffrey Adamski from First Northern Bank. He's the Executive Vice President and Senior Loan Officer there. Jeff's been actively involved in financial services since 1981, and he's been with First Northern since 1993. In his current position, Jeff is responsible for the oversight of the bank's small business, commercial, and agricultural loan teams. He reports directly to the CEO and serves as a member of the bank's senior management team, officers loan committee, and asset liability committee. He has extensive credit background coupled with strong business development and relationship management skills. Jeff's community involvement includes being a founding member and director of the Davis Sunrise Rotary, board member and past chair of the Davis Chamber of Commerce, founding member of DATA, a technology association, and member of the Economic and Finance Committee, City of Davis. Welcome, Jeff. Thank you for participating.
Thank you. I guess one of the things I recognize is I might be the only frontline person here, so we get a good diversity as far as that goes. First Northern Bank was established in 1910 in world headquarters in Dixon, California. So we know small business. We've been doing small business lending for quite some time. I'd say all banks have kind of drifted a bit here over the last probably 10, 15 years, and some of the small businesses have been I don't think, adequately served by all banks. And I think this CalCAP program, we became active in CalCAP, the cash collateral program initially, and it provided us a way in which we could support some of those mid-size opportunities. We don't participate in the reserve account. We've been offered the opportunity to. Really, our default rate in that category is very, very low. It's one of our lowest of all of our categories. We have an automated system that we use from an underwriting standpoint that helps us maintain that. But I'm here to provide some perspective from a frontline lender. Our average loan size, you think, okay, a community bank, we're $1.2 billion, is only $250,000. And the vast majority of the client base from a number standpoint is small business. So provide that input. We have our annual report, 2016 annual report, and we've one of our top 10 competitive advantages listed there is that we are the #1 small business lender for 10 years in a row in the Sacramento region. So we do know small business. We do it well. We do use various support programs to help us with that. I would say the CalCAP program is by far the best loan support program that we interact with on a regular basis. And many times we use it when we have options. It's the first program we go to. Thank you.
Thank you. So, and panel members, as you listen to all of the information presented here today, we invite you to certainly ask questions and comment when you are so moved or curious about what is being shared. To set the context for today's symposium, CalCAP staff identified some key program data to illuminate the success and challenges of the program. First, to summarize the different kinds of lenders that have found value in the CalCAP programs, this slide counts the number of lenders we have actively participating in the CalCAP for Small Business and the ARB programs. Most notable is that we have a significantly large number of state-chartered banks participating in the small business program as compared to the large number of finance lenders enrolling loans in the truck program. Next, we offer a slide that lays out the CalCAP for Small Business performance data by year since 2011. Notably, we enrolled just over 1,000 loans in 2011 and almost doubled that number in 2016. The total loan amounts have increased similarly. We've identified the total amount of CPCFA contributions supporting those enrolled loans. Please note that while the lion's share of those CPCFA funds are from the federal SSBCI monies, the contributions also include deposits from our state general fund appropriation that we received in 2010 and CPCFA's own Small Business Assistance Fund monies for contributions associated with borrowers located in economically distressed areas, as well as those few loans that do not qualify under the federal rules. The number of claims was high in 2011, possibly a reflection of the fact that we had not yet emerged from the recession. After that the claim rate fell back in 2012, and then since then it has steadily risen along with the size of the program portfolio. For your reference, we've calculated the default rate comparing the number of claim applications submitted to CPCFA to the number of loans enrolled by year. And we've also provided the total dollar amount of claim reimbursements for those years. Some other aggregate data for the small business program is summarized here. For calendar years 2011 through 2016, we enrolled almost 9,000 loans for a total of $371 million. The average loan amount enrolled in the portfolio is $49,000. It's well reported that Opportunity Fund is our most active lender in the term of number of loans enrolled. Because of Opportunity Fund's focus being microlending, we thought it might be interesting to see what happens to the average loan amount if we set Opportunity Fund's portfolio to the side for a moment. And when we do that, we see that the average loan amount enrolled in CalCAP doubles to about $103,000. Additionally, in the 6 years that we pulled this data from, we enrolled 63 loans that were over $1 million each. So it shows the wide diversity of the size of loans that we get that lenders find CalCAP useful for supporting. So that is one policy value that the authority holds high, to ensure that this program remains available and useful to the many kinds of lenders willing to invest capital in small businesses and the wide variety of capital lending needs by those borrowers. Looking at similar data for our CalCAP ARB program, after our start in 2011, program enrollment and participation has been and remains exceedingly enthusiastic. Almost 4,000 loans enrolled in 2016 alone, as Anne-Marie indicated. Similarly, the CPCFA contributions have increased. You will note, however, there is a decrease in 2016, which is a reflection of an emergency measure that ARB and CPCFA took to decelerate the expenditures in the fact of the increasing enrollment. We decreased the contribution rates at the beginning of 2016, which is reflected in the data that you see here. As the number of the portfolio matures, the number of claims and the default rate in this program are increasing. Though we note that we are also internally seeing an increase in claims for newer loans in the first 12 to 18 months. Next, we thought it just might be interesting to compare the kinds of loans being enrolled in CalCAP by industrial sector versus the lending to small businesses in California generally, as reported by the Small Business Administration. And these next two slides reflect that comparison. The first slide is the small business lending generally in California to small businesses. This slide reflects the same time frame for the CalCAP portfolio. It's interesting to note that the transportation and warehousing sector leaps out as the greatest borrower sector for CalCAP. And this is the small business program, not the truck loan program. By comparison, relatively fewer small businesses in the healthcare and social services industries are being served through CalCAP as compared to general commercial lending. Similarly, businesses in the professional, scientific, and technical sector, such as accountants, attorneys, and technical consultants, are not as robustly served through CalCAP lending as they are through unenhanced lending. We offer this information simply as a point of comparison for your own edification and hope you find it useful. So next we turn to CalCAP fiscal data. This slide presents the key financials associated with our CalCAP programs, and we've included our collateral support program as well. For each program, we have provided the total funding available by program, the share of the program funding expended or available for administrative costs, and the net funding available for program contributions. We've indicated the program expenditures in each program as of March 10th of this year, and the remaining program funds as of that time that were available for CPCFA contributions in each program. Most breathtaking is the top line, and our staff estimates that the end of the initial federal allocation for CalCAP for small business is very near. We issued a CalCAP program notice yesterday to alert participating financial institutions that, of the pending loans that are currently submitted and under review for final approval and funding, we may have hit the zero balance. It is impossible to forecast precisely, since in the CalCAP programs, unlike collateral support, we do not obligate program funding for loans applications submitted until the final approval. However, in addition to the ever-increasing number of loan applications submitted in the first quarter of 2017, we have received a significant number of larger loans, which has presented the potential of a somewhat unexpected increase in the rate of expenditures. I note that it also, as of April 1st, the lender fee and borrower fee schedule changed by reason of a sunset date in the applicable statute, which will have the effect of requiring lenders to elect only 2 to 3.5% as opposed to 1 to 3.5% too. So that could also present somewhat of an upward pressure on the CPCFA corresponding expenditures. We issued the program notice yesterday to both alert the lender community as to the status of the federal funding for the CalCAP for Small Business Program, and also to explain how, once the federal funding is exhausted, we will revert to our state funds and rules associated with the state-funded program to approve and fund the credit enhancements for subsequent loan enrollments. At that point, our CPCFA contribution will be equal to the lender fee only, and the contributions and fees for those loans will be deposited in each lender's CalCAP state loss reserve account. The second row states the funds remaining in CPCFA's state fund. Of the initial $6 million appropriation from the State General Fund in 2010, we have $2.3 million remaining. It has been steadily supporting the severely affected community contributions as well as the occasional loan that is not eligible under federal rules. However, the expenditure rate will accelerate once it becomes the primary source of funding for all small business contributions. We have indicated here that the funding might end this summer, but please note that this is truly a back-of-the-envelope estimate to be determined only by the number and size of loans enrolled by lenders, as well as the lender fees elected by each lender for each loan. So the end date could be later if our program expenditures slow up. We have indicated our program fiscal data for our collateral support program. We have about $7.3 million of our initial allocation remaining. The loans enrolled and cash deposits awarded for each collateral support loan are much larger than the CPCFA contributions for individual loans in our CalCAP programs. Based on our historic program data, we forecast that the initial allocation will last through the end of this calendar year. We have begun to recapture incremental shares of cash deposits according to the annual recapture schedule and are reserving those recaptured funds for future collateral support loans, as that program was designed initially to be self-sustaining in this way. And lastly, for our heavy-duty vehicle loan program, of the $104 million total allocated to us from the ARB thus far, we have approximately $10 million in program funds remaining, which, if the spring and summer proves to be as robust a sales season as we have seen in previous years, and the increasing trajectory continues, we believe will last until about October of 2017. So having given you our program data to reflect on, we now turn to our stakeholder presentations and look forward to two lender perspectives and their data supporting their recommendations for sustaining the CalCAP programs. So first, we're happy to welcome Ms. Gwendy Brown, Vice President of Research and Policy from Opportunity Fund. Gwendy, please join us. And Christina will flip over. Here, yep. I think that's on.
Good morning. And thank you to CPCFA for hosting us here today, and also to all the panelists. Opportunity Fund has partnered with banks, with SBDCs, and obviously with ARB as well, and so we're very thankful to have you here to share your perspectives and hear from us. So briefly about Opportunity Fund, we are a nonprofit community development financial institution over 20 years old, serving small businesses throughout the state of California. Last year, we lent over $60 million and served over 1,200 small businesses. And we focus specifically on low-income and minority business owners and have served businesses in over nearly 70% of the counties throughout California. So with the support of CPCFA, the CalCAP program, as well as the ARB, what we call the ARB program, or the heavy-duty program, we, as well as many lenders here, have really been able to achieve what we believe is the mission and the purpose of the CalCAP programs. And one additional piece of context that I think may be helpful for our panelists, which is, as some of you alluded to, many banks are not serving small businesses to the extent they used to. And not only are many businesses not getting access to capital through traditional financial institutions, but what we're finding is the only place they can turn for financing, aside from some of the CalCAP lenders represented here today, is to high-cost, unregulated alternative lenders. Our research has shown that the average APR these lenders are charging businesses that came to us was 94%. So again, just to really underline the importance of the type of lending that we're doing all across the state of California in many different types of communities, because at this point, it's not just a matter of those businesses not getting access to capital, but actually having their businesses destroyed through high-cost alternative loans. Next slide, great. So before I begin my presentation or a specific proposal, I wanted to lay out what in Opportunity Fund's mind really is some of the context and assumptions behind our proposal. First, we believe that ultimately the purpose of the CalCAP programs, both the small business programs as well as the ARB programs, are to incentivize lenders to make loans they would not otherwise make. And we believe that the way we should define success of this program is that really the ratio of business loans made or jobs created, so both the number of businesses served as well as the economic impact those businesses are having per state dollar used. So ultimately, we believe that is the way we should be measuring success, businesses served and jobs created. Therefore, we believe that the self-sufficiency of a program is a means to achieving that end. The end is really that we're serving businesses that aren't otherwise being served, that sustainability in and of itself is not the goal, but rather the means to that end. And ultimately, we know we're at that time where we have created a successful program together, and it's time to figure out how to create that sustainability. But again, the sustainability is a tool for greater program impacts. Furthermore, we believe that the power of the CalCAP program is in the risk pooling function itself. Unlike the collateral support program or other guarantee type programs, the state contribution is quite small on any individual loan. And therefore, it's really through the power of pooling that a lender is able to pool their risk and make loans they wouldn't otherwise be able to make. And so it's very important that we don't, again, define success in comparison with programs that really have a very dissimilar premise or dissimilar state contribution per loan. We also believe that match rates are the most effective way to incentivize lenders to serve different populations, whether or not that's different industries, different regions of the state, or other things, or to incentivize new lenders. That the match rates are a very elegant and simple mechanism to use in that way. Because again, they incentivize the loans you want to see, not merely lenders who you hope will make those loans. And lastly, we believe that disincentives for higher default rates are already built into the program, because as each individual lender uses their pool for claims, they draw down on that pool and therefore have less for future loans. So ultimately, we believe that is really already built in there. And we also believe that the strength of the program, as several have indicated already, is on having a diversity of types of lenders, having banks, having finance companies, having nonprofit CDFIs who each serve a different segment of the small business market and therefore have very legitimate reasons for having different default rates based on their business model and the type of customers they serve. Next slide, please. Thank you. So this lays out, when we get there.
Did I lose my signal?
Yeah, proposal, please.
Did it advance?
Light is lighting up.
I know, that's not good. Yep, there we go.
Great.
Thank you.
Thank you all. So as I was saying, this slide presents an overview of Opportunity Fund's proposal, really trying to touch on several aspects of increasing both the sustainability and what we term the integrity of the CalCAP program. So first is a specific proposal around how so-called recapture or recycling of funds could work. And basically the way we lay it out is that each lender can build up and maintain reserves to cover 20% of their outstanding portfolio at any time. Amounts above that 20% threshold of state contributions can be recaptured and recycled for new loans. And we believe that this is an appropriate mechanism both for the small business programs, or the SSBCI, as well as for the heavy-duty programs. And I'll expound on this a bit further. Second, we believe that an additional mechanism that would be very important is to allow lenders to continue enrolling funds against their pool if at any time the state runs out of funds. Case in point, where we may be this summer. Were lenders to have the ability to basically continue to enroll loans against that pool, it would allow those funds to last longer. Third, as Reneé alluded to a few moments ago, right now the match rate has recently been raised, so the minimum contribution the state needs to make, as well as the lender and borrower, is now 2%, which has increased it from the 1%. So reducing that back down to the 1% where it was previously seems to be a sensible approach, a sensible piece of an approach, to make the funds go further. And lastly, we also believe that it's important to clarify lender exit. Right now, we believe that there is not as much clarity as there could be around lenders who choose to exit the program, to return funds to them that they have contributed, and also free up funds for the state. And again, I'll go over each of these in detail. So next slide, please. I have to go faster, apparently.
It's not working. Does it work from your keypad? Yeah, it's working. Okay. But it's not advancing on the. Oh.
Probably the webinar or something.
Oh,
that's good.
No, that went back to the old. Can you click forward? That went to the old presentation. Yeah. There we go. There we go.
Great. So the first component is what we are terming 20% threshold recapture. So again, just to go through this a bit more in detail, the way we envision this is either on an annual or a monthly basis, depending on what CPCFA determines is most sort of administratively simple for them. Each lender would submit a list of, at one point in time, what are all of their enrolled loans that are active? What is the outstanding balance on all of those loans? And then each lender would be able to have 20% coverage of that amount. So if the amount that they have in their loan loss reserve is greater than 20%, the state could then recapture some of those funds to be recycled. If it is less than 20%, no recapture would occur. And so you can see a chart here just showing sort of visually how this could potentially work for a lender who starts off, and you can see that it takes a full 2 years for them to get above that 20%. And so laying out what we see as some of the benefits of this proposal, first, it would, as we've already stated, free up new funds for new loans. Second, it allows lenders to plan for a specified loss rate and makes sure that regardless of what happens, lenders know they can count on a certain percentage coverage in their loss account. Third, this is beneficial for new lenders. We've heard that there is a goal of increasing the number and diversity of lenders in the program, and this would give new lenders time to build up those reserves before recapture would happen. And lastly, we believe that this is administratively simple. One other point I'd like to make about recapture here that is important for the lenders on the panel as well as all to note is all of us as lenders that participated in this program went in with certain assumptions, underwriting assumptions, based on the idea that those funds would be set aside for our loans. Recapture is turning that on its head. We're ultimately saying that we're trying to change the rules of the game retroactively, not simply applying it to new loans as we go forward, because that would take too long for the funds to recycle, but to apply it against the loans that we've made with a certain set of assumptions. So therefore, that to us is a very important piece that lenders need to have confidence in the way this works, and we think that a 20% threshold really gives us confidence that we can act against, essentially. Next slide, please. Great. I think this one is fairly self-explanatory. I've already spoken to it, but again, if if the state runs out of matching funds, either for a short period of time or for a longer period of time, lenders can continue to enroll new loans against their existing account, and the CPCFA can receive an administrative fee directly paid by the lender to basically cover the costs for loan enrollment and claims. We believe this has a lot of benefits, that it can increase lender confidence, that regardless of the ebbs and flows of future funding, that these funds can be put to the maximum and best use. And really this ensures that lenders that are already participating in the program can really maximize those dollars and stretch them over the maximum number of loans and businesses as possible. It provides funding for CPCFA to administer the program, which is incentive. And thirdly, it incentivizes lenders to be prudent with those funds, because we know that as we're enrolling more loans against a fixed portion of funds, we need to be increasingly prudent. Next, please. Again, as far as reducing the required match rate from 2% back down to 1% where it existed, this will allow funds to go further. It's administratively simple and provides greater flexibility for lenders who already have a nice balance to enroll less and require less enrollment by the state as well. And lastly, we do believe that there is a need to clarify how lenders can exit the program and create standardized procedures for returning contributions if a lender exit the program. And we do believe that there should be an option for lenders to exit if they still have claims outstanding. And ultimately what would happen in that case is a lender would give up the right to get any access to those state funds and take back any of their contributions. And the lender share would be proportional to the relative contributions that they put in relative to the state. We think this would increase both lender and investor confidence in the program, which is paramount to making sure that lenders continue to participate. And secondly, there are some lenders who are not participating as actively. And if we can make it easier for them to exit and recycle those funds more quickly, that can also increase program sustainability. Thank you. So in conclusion, we believe that due to the limited resources that Reneé has laid out today, Recapture is necessary, and it can be structured in a way that will not undermine the program's success if the following conditions are met. First, if those recycled funds are used for small business loan and heavy-duty truck purposes going forward. Second, that the risk pooling function that is so fundamental to the CalCAP programs continues with a 20% threshold recapture. And lastly, that lenders can continue to enroll funds if and when there are no state funds available. We also believe that lender confidence and participation is crucial, ever more so, and therefore provisions for lender exit should be clarified. And we also believe that regulatory changes that are discussed here today should also be reinforced through legislation for greater long-term certainty for lenders, investors, and other stakeholders. Thank you all so much for your time, and I'm happy to answer any questions you may have.
Thank you, Gwendy. Turn it over to the panel. Any questions for Gwendy?
I have a question, Gwendy. So in order for ARB to recapture, we have to implement borrower and lender fees because we don't do that currently. So is that part of the proposal in order for us to recapture?
Could you clarify why that would be necessary in order to recapture?
Well, currently, it's just our money into the loan loss reserve account. So in order to build that faster, in order for us to recapture, I think we would need to.
So I think it's important to recognize the distinction between two things. Absolutely, were you to implement fees that would perhaps reduce the amount of funds that were needed on a loan-by-loan basis to fund them. However, that and recapture could be done separately. So, recapture is basically taking funds that are already there and just using them again one time. I believe that as far as and Opportunity Fund believes, as far as the heavy-duty program goes, it really is a double bottom-line program that is serving more goals for California than the small business program alone. The fact that for example, our ARB loans are over 90% low-income individuals and primarily business owners of color, and they're increasing the air quality of our state. And so I think the fact that there's double bottom line, I think the fact that as it stands today, that is a state-supported program is important for going forward. So we are not advocating for putting fees into that program. I certainly are happy to continue that conversation, but that's not something that we are advocating for. We think recapture alone could certainly do a fair amount to provide additional funds.
Thank you. That was an excellent presentation. I would just reinforce your opinion that we need consistency. And one of the things that I would like to see, though, is consistency about how things are recaptured across the programs, the cash collateral program, and so forth. Because one thing as a banker that we get frustrated with is when we start working with a program. Typically, we find out about the issues when there's an issue, and we're trying to make a claim, and we go, "Oh, well, this program has this issue or this procedure associated with it." So, for us, I'd like to see more consistency across the program as far as recapture. I do think the 20% threshold makes a lot of sense, and your ability to enroll additional loans against the pool if funds aren't available is a very good idea. So,
thank you.
Thank you, Gwendy. Now, you're going to forgive me if I ask some very rudimentary questions.
Please do.
Okay. You made the observation early in the overview of the proposal and then reinforced it later that the contribution rate reduction from 2% to 1% would make the funds go further. Mm-hmm. That's just simple arithmetic. But how would one sitting in my chair translate that to some kind of temporal interpretation? How long? I mean, because ultimately I'm going to get back in a minute and ask about loan loss experience and how the 20% should be interacting with loan loss experience. So maybe you can take those two and riff one to the other for me,
sure.
Both in your organization and what you observe in others that may be involved in the program, or generally.
Sure. In some ways, I feel Reneé might be better suited to answer kind of in a macro way how the 1%, how much further that could potentially stretch funds. I think in Opportunity Fund's individual case, we would, given the pools that we have, we could go to the 1% certainly, and we had been enrolling at that rate prior to the requirement to increase it up to 2%. As far as the second question, which please let me know if I have this correct. I mean, basically it's, okay, there's a 20%, but how does that interact with losses, and given that there's different types of lenders who might have different losses? I mean, ultimately what it says is that we have a standard set of rules across different types of lenders, and it allows lenders to build up an account up to that amount. And if you're a lender who has 18% losses or 15% losses, either because of the lending you're doing or because of economic conditions in the markets you're serving, those funds are going to get depleted very quickly, and you're going to need to build them back up through your own contributions. If you're a very risk-averse lender and you're maybe serving kind of the higher end of the market, that might not be the case. Your losses might be quite low. Opportunity Fund's losses, although we are serving, certainly a segment that is tremendously underserved, that banks will not serve, we are serving, low, thin, no credit in many cases, is still quite low. We're still under 2% charge-offs. However, we are starting to see things change between sort of overall national economic conditions, worldwide economic conditions, between the advance of alternative lenders who are virulent in the way that they are approaching small businesses. We anticipate seeing losses increase. And so again, even if our losses right now are low, we know they will go up, and we still believe that having that parity between different types of lenders makes sense, because ultimately we're trying to incentivize a variety of different lending types that serve different subsets of the market. We're not only trying to serve the very near bankable, in our opinion, that are just one step removed from being able to get a loan from this gentleman, but perhaps a few steps more removed, but are still primary breadwinners in their family and really have an enterprise that is employing themselves, perhaps one or two other people, and they're not going to get a bank loan in any case. Does that answer your question?
Yes, thank you.
Can I just piggyback just a little bit on that, just for
Please.
my understanding? Would it be a detriment to have the contribution from the lender stay at 2% and from the state go to 1%?
I mean, that's certainly another way to do it. I mean, there's lots of different ways that you can tweak around with helping lenders get to and stay at the 20%. I think at this point, many lenders are, a good portion of lenders may already be at that place, so that's not really necessary. I suppose down the line, what that would do is enable less. The state would put in less, but they would also recapture less because they would have put in less. So it's, I think it could work. Again, I think the good news is those formulas, once they're automated by lenders, they're not necessarily an issue. I do think, however, it would change, and certainly for, I don't want to say that we're in support of that per se, but I don't think it's an off the table type solution. Thank you.
Thank you, Gwendy. Just a couple quick questions, and I'll do these out of order. On the last slide under conclusions, you mentioned regulatory changes should be reinforced through legislation. Could you elaborate a little more on what you mean by that?
Absolutely. Opportunity Fund is currently sponsoring a bill, SB 551, which in its initial iteration really included all of the proposals as we've laid out today. And we believe that this is important because regulatory changes and really the leadership even of the CPCFA is changed through a political process that happens every couple of years. And lenders were making loans and making lending decisions that will last for a longer period of time than that. And so we believe that at this juncture, it's appropriate to have greater certainty through the legislative process. And right now, the CalCAP programs have some aspects of them that are controlled via legislation and some that are controlled via regulation. So there already are some recapture provisions for certain specialty programs that are done via legislation, and we think that there should be greater consistency across the programs in the sense that that there's legislative sort of guidance, if that makes sense.
Okay, thank you. I was intrigued by a comment that you made about assumptions being made in the recapture proposal, changing some of those assumptions on a go-backward basis. Could you talk a little bit more about that and some complications that you might have in doing that, if there are any?
Sure. Well, I think when we first heard about the idea of evergreening the program or recapture, we weren't necessarily sure what it meant. And the first iterations we saw were in new programs which had a recapture mechanism built in, such as the ADA program and the seismic safety program. And so the rules there are very clear from the beginning. If you enroll loans, this is how recapture will occur. What we're talking about today are existing programs. And my understanding of the intent of what we're talking about today is not merely to change the rules on loans that are enrolled. So say recapture is implemented as of May 1st or June 1st or September 1st. It's not merely saying that recapture will occur on those loans under a certain specified set of conditions when that time comes, but that recapture will occur on all loans that have already been lent. Have already been made. And so that's what's important, is that at the time that Opportunity Fund and other lenders made those loans, there was no expectation of recapture. And ultimately, if we wait until these new loans occur for recapture, it would take literally years to have any meaningful amount of dollars to recapture and recycle. So therefore, we are supportive, if done correctly, of recapture that basically changes the rules of the game after the fact, if it's done right. But I do think it's an important context, particularly for the lenders on the panel, to understand that is a fundamental, meaningful change for all of us as lenders.
Right.
And that's why lender confidence is so important as part of this.
Thank you.
All right. Well, thank you very much, Gwendy.
Thank you.
Thank you, panel. All right. Next, we're going to welcome Mr. Matt Schrap, Vice President of Government Programs at Crossroads Equipment, Lease, and Finance.
Thank you very much, Reneé. With my sincerest gratitude to allow us to give some perspective here on a program that is near and dear to our hearts, but more importantly, near and dear to the hearts of thousands of fleets across California. My name is Matt Schrap. I'm Vice President of Government Programs for Crossroads Equipment, Lease, and Finance. We've been an active lender in this program since its inception. We actually were instrumental in helping modify the programs to allow for participation of finance companies going back into 2009 and 2010, as well as allow the enrollment of terminal rental adjustment clause leases into the program, whereas prior to that, they were not allowed. About our company, we are a California-based company that started in 2006. Our specialty is only truck lending. That's all we do is on-road, heavy-duty truck lending in California and nationwide. Obviously, since we're a California-based company, our central focus here is in building our California portfolio. However, as a nationwide lender and an SBA lender, we endeavor to find the most financially amenable solutions for our clients, regardless of their size and scope. Since to date, I believe that Crossroads has enrolled close to, if not over 3,000 individual loans into this program, the largest lender on the on-road side, and that's why we're sitting up here in front of you today, because we have a tremendous amount of experience with this particular industry segment. So I appreciate the time, and I also appreciate your guys' willingness to understand the difference between the on-road program and how it functions within CalCAP as compared to the small business program, which has different collateral, different customers, different credit profiles across the board. We're talking about the trucking industry here. Specifically in this program, folks that operate 10 or fewer vehicles, which is the majority of fleets who are out there. In fact, the American Trucking Association estimates that over 90% of all trucking fleets operating in the United States have 20 or fewer trucks. In California, we're looking at tens of thousands of individual owner-operators who need financial assistance. So moving forward into the next slide, if you don't mind, some background. As I mentioned, this did begin in 2009, and since we started, as you can tell from the great data that CalCAP staff has put together, we're looking at over 10,000 individual pieces of equipment. This is clean diesel and alternative fuel equipment, retrofits, including aerodynamic upgrades for 53-foot trailers, which help increase fuel efficiency, all in all really leading towards an improvement in overall air quality in California, driving us towards our mission in California of attaining and maintaining federal air quality management guidelines, air quality guidelines dictated by the federal government. Unfortunately, despite the several rules that are in effect for on-road heavy-duty trucks in California, over 14,000 pounds GVWR, of the estimated million vehicles that operate here on an annual basis, 30% of them, according to the ARB, are out of compliance still. Now, as we talk about compliance assistance, we talk about surplus emissions reductions, things that potentially might be, to most people, foreign, very obscure concepts. In the trucking industry, when you've spent hundreds of thousands of dollars to comply with rules, when your neighbor next door hasn't spent any money, it's very difficult to justify future purchases. Now, in the trucking industry, they like to say, one way to make a small fortune in the trucking industry is to start with a large fortune. Nevertheless, it is an integral component of our economy and typically is looked at as the bellwether, as the canary in the coal mine, if you will, in how the economic health of our state and our nation is doing. So despite the fact that there is close to 1 million vehicles operating here, we're still looking at potentially 300,000 of them, over 14,000 pounds, that are not meeting the standards. Next slide, if you don't mind. Now, when we talk about this program in particular, we flash back to 2008 when initially the Air Quality Improvement Fund was set up in the legislature with the idea, in conjunction with many incentive programs that were concurrently operating, to say we want to help those folks out there who are unable to secure financing on their own for clean truck purchases. That was legislative intent, specifically in AB 1338, was to say help fleets that demonstrate financial hardship. That's what this program is about. It's not about economic development. It's about helping small businesses, specifically small trucking fleets, obtain affordable financing so they can purchase highly sophisticated new or used pieces of diesel or alternative fueled equipment that require regular maintenance intervals, as well as several, I guess, truncated use. The old saying is a big, heavy, old-school diesel engine could go 1 million miles before you would have to rebuild it. Granted, this is your grandfather's engine that you could work on in your driveway. You didn't need a laptop to download diagnostic information about the piece of equipment. As long as you had some baling wire, a wrench, and some duct tape, you were probably pretty good to go. So at this point in time, when we look at this highly sophisticated piece of equipment, they are extremely expensive. We even saw a used truck price spike where equipment that was 2 to 4 years old was upwards of $80,000 to $90,000. This is the same industry that was built on trucks that were coming off long haul that went into local drayage use that cost about $10,000. So you can see the economics have drastically shifted. One reason for this is the on-road truck and bus rule, the drayage truck regulation, the transport refrigerated unit regulation, the trash truck rule, the off-road rule, the LSI rule, a whole host of regulations, not to mention periodic smoke inspection program, the heavy-duty vehicle inspection program, idling limits. All of these things cause trucking fleets to have to spend more money to be in compliance. And when you're spending that much money, it's difficult to, in some instances, and in this fleet profile especially, you're more concerned with driving your truck, spinning those wheels, and making money as opposed to necessarily managing your business as a direct business owner. A lot of these guys are just sole proprietors. They've never went to business school. They don't have MBAs. They don't even have accountants. It's a box of receipts, a shoebox full of receipts that at the end of the year they try to figure out how much exactly their expenses were. This is the reality that we're dealing with. For me, these people are the salt of the earth. I've been working with this industry for the last 11 years and really feel that my position now has given me the opportunity to help these folks get into compliance, keep their doors open, feed their families, and live the American dream. As was alluded to, many of the folks who we are enrolling into this program are folks of color. They're minorities. In fact, in the program itself, over 80% of the loans have been issued to folks who are in disadvantaged communities. The program is working, and it's really helping those folks who need it the most. When we talk about financial hardship, again, we lean back on the idea of where this original intent of this concept was. These are folks that could not get financing in the first place. So we took our ability to enroll loans into this program at a certain contribution rate, which has declined since we've begun this back in 2009. We're currently looking at a 4% contribution rate that's come down from 20%. Most of the active lenders, in fact, all of them with over $1.5 million in reserve pool funds, have a 4% contribution rate. As was alluded to, there are no fees in this program. So when we talk about what would help sustain it from the perspective of helping those folks still secure the financial needs, still secure the financing that they need that's affordable, as well as ensure that these folks are going to get into compliant equipment, those who have already purchased, who maybe still need some help, as well as those 20 to 30% out there who are still required to upgrade under the rules despite no grant opportunities, etc. Our three different concepts essentially start off where the larger coalition of CalCAP lenders, it's something that we've all seen as the most simple, consistent way to maintain this program, which is establishing a 20% reserve threshold. Going beyond that, looking at this program in particular, fees, or rather mandatory contributions, we don't like to use that word fees in the industry very much, those mandatory contributions will just be passed on at the end of the day to the borrower, which is just going to increase their costs. Thirdly, we feel that if there is no additional state contribution, and although we're looking at $10 million as of March 21st, although not finalized by ARB, there is $10 to $15 million additional that's being proposed allocated towards this program. So while their funding priorities have changed, they still see a need for this program, especially in sustaining, partly due to the fact that there is still almost 30% of people who are out of compliance. So moving into the concepts, if you don't mind. And as again, feel free to use that quote up there. If you got it, a truck brought it, I like to say, as like a lot of folks do. So one thing is avoid recapture at maturity and set a 20% reserve threshold. This is going to help bring new lenders into the program, knowing that there's something that they can shoot for, while establishing a floor for existing lenders that have really helped build this program over the past 7 years, to say that there is going to be adequate loan loss reserve coverage per recapture occurring. Well, for us, we look at that pooled threshold as being the credit enhancement. With our effective reserve threshold maintained at a certain percentage, we know that we can count on that and not have to worry about going to a loan-by-loan guarantee. If you go to the next slide, you'll see in that vein, if we talk about going directly to recapture at maturity, a lender is going to look at that as a loan guarantee. They're not going to look at it as a pooled reserve. Even though it has the ability to be enrolled into the pool, the uncertainty about what level your threshold is going to be at time of origination, you're just going to say, I have a 4% contribution on it that is going to be good for 60 months, period. So in the example that is under that, typically, if you're in a Tier 4 or Tier 5 credit scenario, these are not necessarily subprime borrowers, but for the most part, these are folks who have never commercially financed a vehicle before. If you've never commercially financed a vehicle before, very few people are going to be falling all over themselves to issue you a loan, especially your bank. We find that the valuation is difficult for some financial institutions to wrap their brains around, especially because of the rapid depreciation in this equipment because of the highly sophisticated emissions technology. So when someone comes to any lender with a particular credit profile, what's extended to them is an approval, but with stipulations. You're going to have to come up with 20% down if you want to try to get into this vehicle. Most lenders want to see some skin in the game. Where we're able to utilize, and most lenders are able to utilize the loan loss reserve threshold, is to say, okay, per the example, if I have 17% outstanding loan loss reserve coverage, someone comes to me and says, or we say to them rather, my credit is dictating, you're going to need a 20% down payment. I can use whatever that loan loss reserve coverage is as if it were a down payment, not necessarily reducing his capital outlay, but reducing the credit threshold that is now necessary for him to get into that piece of equipment. So instead of someone needing to come to me and needing to put 20% down, now they're looking at 2 to 5% down, which that is a major hurdle for folks getting into clean equipment, whether it be new or used, is that initial capital outlay. And unless you have stellar credit, it's very rare to get 0 down. And in this industry, unfortunately, unless some folks have some skin in the game, it makes it much easier for them to walk away from the collateral, which at the end of the day just creates more issues down the road. So very important to understand that that pooled reserve threshold is acting as a credit enhancement merely because we have such, challenged credits who are out there who are the ones who are really borrowing this money. This is typically a single truck guy. He has one truck. That's all he's got. He doesn't have an apartment building that he's looking to ADA retrofit or seismically retrofit. It's not a restaurant. It's not a bakery. It's not a franchise. This is one man, typically, one woman, one truck. If you don't mind going to the next slide. As was alluded to before, we're looking at all lenders, active lenders today with a 4% contribution. That's not much. So if the same gentleman came to me or lady came to me and said, we want to get a loan, it says you need to come up with 20% down. Now you're up to 15%, 16% that you need to come down with. And that is typically, in our experience, the main hurdle for folks to get into this clean equipment is that initial capital outlay. So the credit enhancement is essentially used to offset that and get people into this clean equipment, which at the end of the day is the motivation of this program. Again, it's not economic development. It's about getting dirty trucks off the road and getting clean equipment into the fleet, turning over the legacy fleet so we can meet those federal air quality attainment guidelines. Moving on to the second concept, fees, mandatory contributions. Although it's attractive to look at to say we want to continue program sustainability by charging more fees, the problem is that because of the way this industry is structured, those fees are eventually just going to be passed on to the end user, one way or another. The more hurdles you put in front of these folks, the more difficult of a time they're going to have achieving affordable financing. For us, we think that any type of inclusion of mandatory contributions is just going to serve to turn more people away at the door and have them seeking out some of those subprime predatory lenders just to keep the lights on. There's an APR percentage cap that exists within CalCAP today at 20%. Ourselves, as many of other of our colleague lenders, avoid getting to that 20% if possible. But there are folks who are issuing loans well outside their normal credit parameters because, going back to the mission of the program, this was to help folks who are demonstrating financial hardship. For us, and for, again, many other lenders, we're not engaging in risky behavior here. What we're doing is using our existing credit parameters and having the pool act as the enhancement. So anytime you start sprinkling in more fees or more costs into this, they're just going to be passed on to the borrower at the end of the day. It's just the reality of how this industry works. Third and final, we would also request that if there wasn't additional state funds that were being contributed into the loan loss reserve, that lenders should be allowed to continue to enroll at risk of their own pool depletion. We think that there's a great need out there, and just because there isn't a state contribution, lenders still have the ability to go and find folks who are going to be in need of getting this equipment, getting into this clean, more efficient equipment. And to have that ability at the end of the day would help sustain the program, would also give us more peace of mind about, for lack of a better term, not guaranteed funding. So relatively straightforward. I think that at the end of the day, for purposes of consistency, having a 20% reserve threshold across all programs is the no-brainer. From our perspective, the on-road program is vastly different from all of the other CalCAP programs or the entire CPCFA portfolio, primarily because, again, this is not an economic development program where we're looking at extremely different credit profiles. We are a frontline lender also. We are in several dealerships throughout California. We do direct lending at the Valley up into upper Northern California. We have a diverse set of clients, and every single one of them has one mission involved, and that's to be in compliance with the Air Resources Board rules. As first and foremost, if you're operating in California, because you can't operate here if you don't meet the standards or unless you report to the ARB for some type of exemption. And the exemptions are very thin in their applicability. There's incentive funding out there, but it doesn't help those folks who are out of compliance. This program can help people get out of that dirty equipment and get into clean equipment. I always like to say to folks, remember the mission. For us, the mission is driven by the legislature. Help those folks who cannot help themselves. Help the industry get those dirty trucks off the road, get the clean equipment out there, and provide a mechanism for lenders to at least mitigate their risk when they're entering into these agreements. When this program started in 2009, one exercise that we did is we called every single on-road lender or every single lender that was engaged in CalCAP and asked how many loans they've enrolled into the on-road program. The answer was 0. We took a strong effort and started engaging some of our fellow lenders to get involved in this program and to start building this up. There was a point where ARB had come to lenders, did an RFP for someone to manage this program. One of its other monikers that you might know is providing loan assistance for California equipment, the PLACE program. I do love acronyms, so I couldn't resist sharing that one. But nevertheless, they found that it was very difficult to try to administer a loan guarantee program through a third-party contractor, and that the preferred way was to go through the Treasurer's Office that had set programs that were in place and infrastructure that could be used. The agreements that were entered into by lenders back in 2009 had nothing to do with recapture. If we were told in 2009 that these funds would be recaptured in the near future, we would have approached this very, very differently. And right now, to go straight to a recapture at maturity is really akin to changing horse midstream. We would have never made these credit decisions if we knew that we were going to have the floor pulled out from under us through some type of recapture. More or less, that's generally it. I would entertain any questions at all whatsoever, and hope that it came through clearly enough that, again, if you got it, a truck brought it, and we need this program to help continue to turn over equipment, get that dirty equipment off the road, and help California's small businesses in this industry be successful. Thank you.
Thank you, Matt. Turn it over to our panel to ask any questions.
I'll just ask a real quick one. First off, spot on presentation. I mean, it's nice to see someone so passionate about what they do. It came out very clear. What is the typical loan amount for something like that, and what's your average default on something like that?
It depends within the credit tiers. Typically, we're looking from about a 3 to 5% default, depending on credit tier. Fleet size has a lot to do with it. Average loan amount is anywhere from about $40,000 to $56,000, I would say. That's on used equipment typically. And how we structure a used piece of equipment versus a new piece of equipment are much different. If you get into a new piece of equipment, you're looking at federal excise tax with a 12.4% right on top, local sales tax, et cetera, et cetera. Very expensive for folks. So in this fleet profile, they would rather go used, but again, used equipment has gotten very expensive over the years as well.
Forgive me, I probably should, know the answer to this. Do you make loans to businesses outside of California?
The threshold for eligibility in the CalCAP program is essentially 51% of your economic effect. How it's structured for the on-road rule is to say if 51% of your miles are in California annually with the new vehicle, then that would qualify as well. So in a very, very rare do we get folks who are based maybe in Reno, possibly in Las Vegas, who are doing most of their miles in California, then there is that possibility, yes.
Okay, so I just wanted to clarify the million trucks is national.
Million trucks are what is operating in California on an annual basis, both in-state and out-of-state.
Right, so 400,000 are registered in California. I just wanted to make that clarification.
And per those numbers, that would say almost half of them are out of compliance, or compared to at least 30% of them from that angle. So if we go down, maybe it's 100,000 vehicles instead of 300,000.
Tim?
Thank you, Matt, for the presentation. I'm going to ask some questions that I suspect I know the answer to, but I want to hear anyhow, because I'd like to hear your expansion of it. I think you've made it pretty clear from the discussion in your presentation that this program, because of its statutory DNA, is quite different from other programs. So I'm going to ask you a softball question then. So if you pooled fees and contributions from all CalCAP programs into a single loss reserve program, you would probably think that is what kind of an idea?
Bad.
Okay. All right. Just confirming. Okay. You have a lot of experience with this program. What thoughts could you offer the panel and the staff at CPCFA on what they might do to, going forward, to encourage other lenders, competitors, to get into the program? You mentioned that twice during your presentation. What advice would you give? What advice would you give me if I were going to become a competitor?
I would say there is parameters currently in place that would entice a lender to come in, that specifically being a 20% contribution rate. So if you come in right away, you're getting a 20% contribution on any eligible loan that you enroll into the program. Now, from an outreach perspective, I think that there would be a function potentially through ARB, which they do a good job of telling end users that this program exists, but maybe there could be a little bit more robust effort in outreach saying to established lenders in California, hey, there's a program out there that we think can help get some of these trucking fleets into compliant equipment. Why aren't you participating? What's holding you back from participating? And please come on down. We'd love to have you. I think that it's a function of outreach more so than programmatic structure.
And by outreach, you don't necessarily mean, I want to be careful that I don't make the word sales into a pejorative term, but outreach is education and information flows as opposed to
very much
just
so, yes.
Naked selling.
Right.
Okay. All right. Given the size of, you indicated that your typical loan amount was $40,000 to $56,000. That would suggest to me, correct me if I'm wrong, that a reservation system would probably be of little use to you. You might be more interested in that if you were operating on brand new equipment with higher price tags. Is that a fair assumption for me to walk away with?
Yes, I believe it is, primarily because, again, the profile that we're serving is motivated towards that used equipment. And granted, because of the technical sophistication of some of the equipment that's coming off the line, is more expensive. And I would think that even probably a 60 to 70 as of late would maybe be a little bit more appropriate. If we're going back to 2009, that's where that average number would come in. The other thing about the industry is that it does ebb and flow. In the first quarter here of 2017, there has been very little new and used truck sale activity. And that's just been a function of folks that had bought a lot of equipment last year, a focus of some of the rules here in California having a gap before 100% compliance is necessary at the end of this year, which may drive some additional purchases. But a reservation system from that perspective, we would think that having the funds available on demand is going to be much more preferred to us unless we start getting into those much larger numbers, which a new truck out the door today in a sleeper berth configuration cost you upwards of $170,000.
Okay, so then that begs my last question here, and my lending days are long, long behind me. So this is perhaps a naive question coming from somebody with 45 years of rearview mirror behind me. When the collateral rolls and it's movable, recoveries are a different kettle of fish, and recoveries of a piece of equipment like this can be quite expensive if you look up and discover it's sitting in Wisconsin instead of somewhere in La Brea. So are you prepared to share what your recovery rates are? You indicated a 3 to 5% default rate. What is your recovery rate upon it?
To be honest, I wouldn't be comfortable just giving an answer off the top of my head, because that's something that I'd have to say that I wasn't necessarily completely prepared for, and I don't want to have my lending years in my rearview mirror quite as of yet.
Understand. Thank you.
Having said that,
now you know why I'm up here.
An enviable position. Having said that, one thing that most lenders do with any type of rolling asset is require a GPS. And so we have the ability to track that vehicle wherever it goes. We can set up geofencing if necessary. But typically, we aren't watching these guys like Big Brother. We only look when we've got a problem. And we're contracted with repossession agencies all over the country. And so no matter what, we will find that truck. Granted, mother is the necessity of invention. I think that's how you say it. Excuse me. Nevertheless, we've gone through the motions with some borrowers who have gotten pretty creative in pulling out and finding that GPS unit. It is buried inside the dash. It is no small task in getting that thing out of there. So we've become very adept at making sure that they don't have the ability to just unplug the thing and go off to Mexico, Canada, Boise, Idaho, Montana, wherever. Typically, we have a very good recovery rate. I would venture to say it's close to, if not 100%.
Thank you.
Any other questions? All right. Well, thank you, Matt.
Thank you very much.
And we now have earned a well-deserved break. It is. It looks like it is 11:49. Let's return right at the top of the hour at noon. We'll reconvene. Thank you. We want to provide CPCFA's staff data and an analysis in support of two different approaches to recapture. As was mentioned, Senate Bill 551, authored by Senator Hueso, proposes a recapture for the CalCAP for Small Business program, and we note that a number of you participating today support that bill. And the current language in the bill seems to reflect what both Opportunity Fund and Crossroads have proposed here today. And based on that assumption, we have taken the assumptions built into the proposals that you've heard already, and we've applied that to our current loan portfolios in both the small business and the ARB programs respectfully. And then we've also applied a slightly different way to establish a threshold, taking to heart and into consideration the need for a threshold. And we were proposing the consideration of something slightly different. So the first is what we're calling the Stakeholder 20% recapture scenario. And just to be clear that we're all on the same page when we're using certain terms or references, we interpreted the proposal to mean that the 20% of the outstanding principal balance of enrolled loans at any given time and this is all on a per lender basis, that the minimum threshold that would remain in the loan loss reserve fund following any kind of recapture would always be at least 20%. In other words, the effective recapture would never bring the threshold in the loan loss reserve fund down below 20% of the outstanding principal balance of enrolled loans. And then based on having set that threshold, the amount available for recapture for a given lender would equal the total public contributions for loans that have matured or that are older than 5 years from initial origination. And that further, we would not count in the total public contributions any contributions related to loans which in fact had defaulted. Compare that to a straw proposal that staff has applied to the same data set. And we're calling this the contribution ratio calculation. As you've heard today, under the small business lending program, there is a variable contribution per loan into a lender's loan loss reserve fund, depending on the fee that the lender selects for that loan at the point of origination. And we'll be explaining this in a little more detail. However, what this will do, what this ratio calculation would do, is it would set the threshold relative to that lender choice made at the time of each loan enrollment. So this ratio calculation, the formula looks like this. The loan loss reserve balance over the outstanding principal balance would always be greater than or equal to the total fees and contributions for each lender over the total enrolled loan amount in that portfolio. Several assumptions remain the same as with the Stakeholder 20% proposal, which is that the CPCFA could recapture all public funds contributed for all loans which have either matured or exceeded 60 months since disbursement and which did not default. Taking this or applying this formula, what it does is it highlights the fact that the decision made by each lender determines the level of CPCFA's contributions for each loan and the total amount to be deposited in the lender's loan loss reserve fund for each loan. And taking that decision at the point of origination as a reflection of the lender's estimation of the risk associated with each loan, this alternative calculates the aggregate risk and corresponding investment by each lender in this risk-sharing program. So specifically, the threshold for each lender becomes the total of the fees and contributions as a percentage of the total amount of enrolled loans. Given the range of lender fees, and again, this is pertaining to the small business program, given the range of lender fees that each lender can select, the total fees and contributions for each loan can actually range from 4% to 17.5%. So it's a pretty considerable difference for some loans. What we see from CPCFA's perspective as we're approving and enrolling loans on behalf of lenders, some lenders always select the same initial fee. Some lenders always select the highest. Some lenders always select the lowest. Some lenders select it loan by loan for whatever credit decision that lender is making relative. So we see a lot of different behavior, and we like to allow that freedom to exist. However, what this formula would do is it would set the threshold for each lender based on that lender's independent decision-making, reflecting their assessment of the risk at the time they're enrolling loans. So applying and comparing these two thresholds, This slide shows how the two approaches would work for 4 sample lenders, and this is in the CalCAP for Small Business program, based on our data collected from these lenders' enrollments, claims, and quarterly reports. Of note, the top line for these sample lenders reflects their current loan loss reserve balance. The yellow row reflects the share of contributions from CPCFA, including our federal and state monies that we've contributed based on the small business contribution formulas, for the aged out loans which have matured or are over 5 years old and which have not defaulted. And then the green rows show, after applying the 2 different methodologies, which amount would actually be recaptured for future program use under these 2 different scenarios. We note that this data reflects the likely recapture from these sample lenders in only the first or the initial year of applying a recycling mechanism. We suspect that future years would not be as robust, since the contributions associated with the oldest loans enrolled at any time would be swept initially in the first round, and that in future years, only 1 year's worth of recapture would be available for potential collection. We note that neither approach accounts for lenders which have higher claim amounts, which may have drawn down their loss reserve accounts more rapidly. And in that vein, a methodology which ignores that aspect of the activity in the loss reserve account could serve as an incentive for lenders to file claims early before completing their normal liquidation and collection efforts. But we leave it to each of you to draw from these sample data sets what's notable or important to you. Turning to the CalCAP for ARB program, we have provided the same data sets for 3 sample lenders participating in the ARB program. Here, the reason for the variable percentage under the ratio calculation is not a reflection of the lender's selection of the lender fee at the time of enrollment, but rather the variation in the CPCFA contribution as it has changed for the program over the years. As Matt indicated, there's a graduated contribution schedule. At the inception of the program, it was identified as an important priority to incentivize new lender participation in the program, and therefore there was a 2-step contribution schedule that for new lenders up to a certain portfolio amount, their contributions would be 20% of the enrolled loans. When they reached that magic number, the contributions would drop. Over the 7 years of the program, that lower contribution has varied. At one point it was 14%, then it dropped to 10%, and now where we're at, in order to slow overall program expenditures, we have a 3-tier program contribution schedule where it's 14%, 10%, and 4%. So what this variable rate here for the ratio calculation reflects is that for each of these lenders, that threshold is the average of the contributions that we've provided for the loans over their entire portfolio of loans that they've enrolled, regardless of what the contribution for each loan was at the time that it was enrolled, if that makes sense. So with that, we'd like to turn to participant comment. We have 7 people who've indicated they'd like to provide some comments. So we think that given the time, each of you can take 3 minutes, and we can still get out of here in time as scheduled by 1 o'clock. So we're going to start with Mr. Shervin Rashti. Just so you know, following Shervin, we'll have Claudia Veek and Gabriel Villarreal. What I'd ask as each person addresses us in the panel, welcome, Shervin. You identify your organizational affiliation, and we will have a respectful, hopefully, color coding system for when you're nearing your end of your comments. Yellow for when you have 1 minute left, and red for when we'd kindly ask you to conclude your thoughts.
There's no green? No green.
Go.
Well, thank you for having us, and thank you for joining us on the panel. My name is Shervin Rashdi, COO for Maxim Commercial Capital. We are a subprime specialty finance company that has a portfolio that's very much involved with truck financing, and we participate heavily in the ARB heavy, over-the-road heavy truck program. One of the factors that we'd really like to address is obviously the Recapture initiative, and just wanted to voice our concern with the proposed changes with respect to individual Recapture as opposed to some of the other proposals that have come about, namely the 20% threshold. When we went about underwriting these loans, we did it with the mindset that these are done with the offset of having the loss mitigant of the Recapture, or I'm sorry, the CalCAP reserve program on hand, based on initially what starts as 20% and then, as discussed earlier, all the way down to the 4%. With that kind of initiative in mind and having the reserves available, that's given us the ability to underwrite to those without really any thought to having that be recaptured or changed or modified in any way. So it really has given us the ability to lend to a broader scope of borrowers, which I believe is the spirit of the whole initiative to begin with, and gives us the ability to do so working with other dealerships. We work with the different borrowers. We work with different lending institutions, syndicates, et cetera. So a lot of additional proposed items have taken place in the framework of having this reserve in place. So I just wanted to voice our concern with making that retroactive type change and how it can really impact us as lenders and our ability to really continue forward in doing what this whole ARB program was set out to do, and put clean trucks out on the road. So thank you.
Thank you, Shervin. All right, Ms. Claudia Wieck.
Thought I'd be last because I got my notice, so I guess they shuffled them. Thank you today, panel, for hearing the excellent presentations. Cameo is a statewide network of micro business and micro lenders, and we have 122 nonprofit members that served about 45,000 small businesses, largely in low and moderate income communities. About 33 of our members are lenders. Most are CDFIs. In fact, Mr. Daniel here from the SBDC, and there are a number of our members in the audience today. I want to thank Reneé and all of you for this program today. Cameo is a very strong promoter of CalCAP and will continue to promote it among our lenders, because we feel it is fulfilling a mission which was established during the Obama Jobs Act of providing access to capital in underserved regions. Many of you already serve those regions and are helping to revitalize our economy in many areas which has not recovered. So first, I want to say that I want to talk to 2 points. One, that the recapture of CalCAP revolve to the original use to benefit small and micro businesses, and that we believe in establishing the 20% threshold for recapture, since if that's going to be in fact happen, we would like to support what the 2 other presenters said. We want lenders to be able to count on these reserves and to build up a healthy reserve. And also, we need to really think about sustaining these funds during the ups and downs of our economy. And boy, we have wasn't that long ago that we really saw high defaults. And I want to reassure you, too, in case you're not that familiar with the nonprofit CDFIs, their default rates are very low, less than 5%. My second point is a little outside the box, but I want to take this opportunity to urge you, again, to fulfill the original mission of CalCAP and the Jobs Act for economic revitalization, to take a small portion of unspent funds to offer grants for technical assistance to your lenders in good standing. The technical assistance to borrowers is the pathway to capital. And I know Mike Daniels said so eloquently, 100-to-1 leverage with the technical assistance provided by the SBDCs. You can't find that anywhere else. So technical assistance, which is, coaching on access to capital and knowing your financial projections, creates a stronger borrower, a borrower that's going to pay back that loan and be a better customer in the future. So for that reason, even though it doesn't exist right now, it has been done by the iBank, which also has Jobs Act funds. They've provided some funding for the Jumpstart program for very small microloans. And I would like to urge CalCAP to consider this option as another way of generating better borrowers and more loans. Thanks.
Great. Thank you, Claudia. Gabriel Villarreal.
Thank you, Director, for the opportunity to speak, and thank you to everybody here on the panel for being here today. My name is Gabriel Villarreal with Opportunity Fund. You heard our VP of Policy speak earlier, Gwendy Brown. Just wanted to do a quick reflection on, I think, the Recapture proposal that we just heard. First, we think that the purpose of our proposal, the 20% threshold Recapture, that really serves two purposes, and the program really has two purposes. One, it's to serve as a credit enhancement to those without access to capital and thin credit profiles, your small businesses, your small truckers, those that really, really aren't being served by larger banks. And then additionally, it's the purpose of the program is to serve as an insurance fund in case there's an economic scenario like we saw back in 2008 where originations decline and charge-offs increase. The 20% threshold really accomplishes both of those things. First, it allows us to be guaranteed a particular loss portfolio coverage. So if we were to experience up to 20%. Again, these numbers were based off of the losses that we saw back in 2008 during the financial crisis. We can say with confidence that as an organization, we'd be able to absorb that, recoup our losses, and continue to lend to small businesses in those times when they really, really need capital the most. I think it's been made pretty clear during the symposium that there are funding pressures, and we understand that SSBCI funds are being drawn down upon, ARB funds are being drawn down upon, and we really appreciate the program. We've been able to do a lot with it, and we really would like to see it continue. However, we would like to see it continue in a way in which we, as a lender, as a CDFI, can continue to serve our target populations of low-income and minority small business owners. Now, this is still kind of digesting and reflecting on the recapture process that we just heard about. This is the first time that we've seen this proposal from CPCFA, but we do very much thank them for their diligence and thought that went into it, and we're looking forward to working together on future recapture proposals. But we do still think that a 20% threshold recapture is the most appropriate way going forward, as this is based on economic stress scenarios that we have seen in historic charge-off rates during recessions. So, thank you.
Thank you, Gabriel. All right, next, Mr. Matt Schrap. I'd like to return to the mic. Following him, we'll have Gwendy Brown and then Mark Nemanik.
Thank you, Reneé. As I've been testifying before many boards and commission, a lot of people know I'm no stranger to a microphone, so I apologize for beating this horse, so to speak. But I did want to bring up one specific thing in regards to the comment that Ms. Rogers had made about the number of vehicles operating in California. although that we talk about on an annual basis, there's 1 million vehicles operating here. More than half of them do come from out of state. That puts enormous pressure on California-based businesses to compete in this environment. If you're looking at the Swifts or the Swifts and the Knights of the world, the J.B. Hunts, the Schneiders, these massive trucking companies who are based in other states because, frankly, they have the ability to do that, not to mention FedEx, UPS, some of the other package van carriers who also have the ability to register vehicles out of state and bring them into California, is placing these California businesses at an additional disadvantage. Right now, the Air Resources Board is promulgating or has just begun as of yesterday, potentially looking at a rule to electrify all local trucks, which means any truck that's coming back to the same place every night, a la drayage truck, package delivery van, full electric platforms, which cost anywhere from $300,000 to $550,000 per vehicle. You have this, you have additional inspection and maintenance requirements, which is going to also increase the initial cost for people to maintain their equipment. Granted, sometimes people need a little bit of a help up and a hand out in order to make sure that they're maintaining this highly sophisticated equipment. Through a regulatory measure is not always preferred, but one way is to definitely force the horse to drink the water as opposed to just lead them there. So keeping that in mind, along with the potential another rule in the ports of Los Angeles and Long Beach, which would require ultra-low NOx engines, which on average currently with the platform that reaches this ultra-low NOx standard, you're looking at $80,000 to $100,000 above and beyond what the cost of an existing truck is today out the door. And this equipment is only available on new vehicles. So as we look at all these mounting costs, we go right back to the issue of these end users having the ability to afford to get into compliance, afford that clean equipment, and having a 20% reserve threshold that lenders can lean on, knowing that it's there, the floor is not going to be taken out from under them. They're going to continue to issue these loans and hopefully continue to give lower cost options and affordable financing to these people who need it most. And really who this program, the on-road program, PLACE, ARB, whatever we want to call it, was originally created for. So thank you again very much for your time.
Thank you. All right. Gwendy?
Thank you again to the panelists. This is Gwendy Brown again with Opportunity Fund, and thank you for the two proposals. As my colleague mentioned, this is the first time we're seeing them, so trying to kind of reflect on the fly about comparing the two programs. And ultimately, in my very quick analysis, Opportunity Fund remains very supportive of the 20% threshold scenario because, again, it gives us confidence in the proportion of coverage that we have, and at the same time, it allows us to build up beyond our contribution rate. So my understanding of the sort of the contribution rate proposals that it basically Recapture is set so you can never get below what the total contributions were. But it really rewards lenders who have good underwriting and have good collections practices because it basically allows us to keep and build up anything that's on top of those contributions. So in years and months when we're able to squeeze a little bit more and really make those loans work, we save that up for a rainy day. So without that 20% recapture threshold, using kind of just the pure contribution ratio, it really takes away that incentive to allow us to kind of save up acorns for a rainy day, if you will. That said, we again appreciate the conversation and look forward to continuing. Thank you.
Thank you. And Mark Nemenek?
Good afternoon. My name is Mark Nemenek. I work with a group called 3CAR. We're based in Chico, California. We're a small three-county CDFI. We've been in business since 1985. And we are specifically a business lender. We've been a CalCAP lender since 2007. Prior to 2007, all the money that we had in capital was public money. Since 2007, we've been able to raise $7 million in private money, and almost exclusively all our lending is based on private funds. We couldn't do that without having loan loss reserves because prior to 2007, our balance sheet wasn't deep enough to be able to raise money privately. One brave bank, Wells Fargo, stepped up and did the first investment for us. And since 2007, CalCAP has helped us to build the depth in our balance sheet and be able to raise money privately. Right now, CalCAP makes up about 51% of our total reserves on our balance sheet. Our historical loan loss losses are 1.5%, And we're very much of a relational lender. So we don't do a lot of volume. We have a very capped audience and territory. And so we do smaller volumes, but we're much more side by side with our clients. As a 501c3 nonprofit, we also raise money privately, charitably, and then we reinvest that money into technical assistance with our borrowers. And that's why our loan loss experiences are very low, because we're very high touch and really focused on making sure we're giving them a lot of help along the way. Now, for us, the most critical thing in terms of incentives is that the more unrestricted reserves that we have on our balance sheet, the more we can raise from prospective investors, both individuals and institutions. And so I'm encouraged with the 20% rule, because what it does is it essentially creates predictability, and I think that's really important. I also think that if, in our case, since we have not made any claims in the last 10 years, there should be some incentive in terms of, if there is any recapture, that there be consideration for some of that to be brought back to the lender as a carrot, so we can build continuing our unrestricted loan loss reserves. And I would encourage the panel to kind of consider those types of things, and I'd like staff to look at that as well, because as a small CDFI, in fact, north of Sacramento, there's only 6 of us out of about 88 CDFIs in California. Those kinds of tweaks would be very helpful for us as a lender.
Okay. Thank you. All right. Last, we have Juan Carlos Hernandez from Acción.
Good afternoon, everyone. Thank you so much for having us. My name is Juan Carlos Hernandez. I'm actually the Chief Credit Officer with Acción. We're based out of San Diego. Currently, we're actually serving 4 counties, which is Riverside, San Bernardino, Imperial Valley, as well as San Diego counties. We've been around, obviously, since 1994, and the CalCAP program for us really dictates, or has really helped for us to continue our mission-based lending. Our portfolio really shows about 75% of low to moderate income families that we are actually helping. Excuse me. 2 of these statistics that were not included today that really shows the success of CalCAP is the number of jobs that have been created as a result of the funds that we put out in the field, as well as the number of jobs that have been maintained. Specifically in our region, in our market, considering who we target, the families that we target, this is primarily either their primary source of income or a secondary source of income to make ends meet. So to us, as I would love to be able to say, we would like to not see any changes in the CalCAP program. Obviously, that would be a very selfish situation. However, we really are very supportive, at least maintaining the 20% for our portfolio, because again, as everyone has mentioned, this allows us to continue to plan for our future and to be able to kind of determine as to how much of this we can continue to keep to continue to service these low, moderate income families. And to us, really, they are families. One of the things that has really helped us tremendously is the technical assistance program. This is an education that we continue to offer all of the people, all of the market that we service, because it is important. As Matt was talking about, we actually see more than half of our clients who really show, and they don't know what a balance sheet is, they don't know what a profit and loss statement. So it's incredibly important for us to also, in addition to the access to capital, to provide this additional education for them. So, and again, the fact that we can count on this loan loss reserve program really helps us to make decisions, at least in my role as Chief Credit Officer. It helps me to make a decision on a borrower that is kind of in the middle of the fence, which as a banker, it's very difficult sometimes to it. And for me, it was very difficult to make the transition from a commercial lender in private banking for 20 plus years to come in and join a nonprofit mission-based lender and make those decisions. And the difficulty of going from a very conservative to more of a mission-based is really difficult, but it is sustainable. And I think this 20% program that everyone is really in support really provides us that additional, tool to continue to service our community. Thank you so much.
Thank you. All right. We are well on time, and with that, I'd like to allow our panel members an opportunity to digest what they've heard today and offer any observations or recommendations as we move forward.
I'll just pipe in. The thing I've heard is, first of all, we have some fantastic participants in the program. And while they're non-bank lenders, they are lenders, and they do need that stability and to plan for their future. And they're doing some pretty sophisticated planning from my conversations that we had at the break. So the 20% sounds like a reasonable goal to me. I was just wondering, is there some way that we could grandfather in those individuals, and then perhaps new members? Here is the revised guidelines that you'll participate going forward. So such as First Northern Bank, if we came in, we may not have that, but then we can plan accordingly and make our moves accordingly and decide if we want to participate in the program. It doesn't sound to me like there's a participation issue. I mean, we're running out of funds. We just need to turn those funds a little quicker. And some of the measures that you've proposed and we've heard from the others, I think, would do that. So it's been enlightening for me, and it's been great to participate. So thank you.
Thank you.
So this is Anne Marie. I just would like to say, I mean, we absolutely realize the importance of the truck loan assistance program. It's a success story. We tout it all the time. I mean, the ARB is very much supportive of continuing this program. We have made adjustments when necessary. We have found additional funds when the demand has increased and we didn't provide enough funds initially. So we're very, very supportive of the program, but we do need to figure out how to recycle some of the investment because we do have those other competing priorities, and that's what we're trying to get. So we want something that works for the lenders, for the borrowers, for CPCFA, and for ARB, and I think that we still have some work to do. We'd like to maybe dig down a little bit more and look at lenders and default rates and put everything out on the table. But we've heard you loud and clear today, but I still think we need to do a little more work.
I want to thank everybody who participated, including those who offered the proposals and those who provided public comment. I understand that the 20% recapture scenario may include a retroactive application, and I'm curious whether or not the contribution ratio calculation would also include retroactivity or whether that's intended to be prospective in nature.
For the working straw proposal we offered today, we applied the same assumptions from this 20% stakeholder proposal, which is the retroactivity, so that it's mostly comparing apples to apples, the only difference being how that threshold is calculated.
One other, and this is going earlier into the first part of the presentation where it was documented as to the number of participating financial institutions. Is that a snapshot of those currently participating?
That is a count of how many lenders currently have loan loss reserve funds. There are a few lenders in each program who don't participate as actively, or maybe it's been a few months or maybe even longer since they've enrolled a loan. But by and large, they're active lenders.
Thank you. And I would pick up on a comment that David made earlier, which is the industry has been under extraordinary pressure, and consolidation continues to be an ongoing event. I'd be interested on a go-forward basis if you can help us understand the percentage of those lenders as a consequence of those that might be doing business in California, because I know we work very closely historically as an association to raise awareness about the program and the benefits of it in a variety of different forums, whether it's CalCAP, whether it's collateral support, whether it's small business loan guarantee program, or even the more recent seismic strengthening program.
I just wanted to say a couple things. One, some of the stories that some of the lenders were telling, I think capturing those would go a long way as well. You know, I mean, you talked about some metrics, jobs created, jobs retained. I mean, those are such good stories to be able to tell. And then the other piece, too, was, I don't know, we got into a reserve pool and being able to reserve some of the funds. But for the lenders that are in good standing, to create some type of system where they have access to more funding than others. So that's kind of what I got. So
thank you.
Thank you, Reneé, and thank you to your staff for putting this together. I want to echo the comment you just heard that this dovetails very nicely with my own instinct on it, and that is that when a lender is managing, it seems to me that when a lender is managing his or her exposure effectively to good underwriting standards and the access to the loan loss reserve is for what are truly the outliers on the shoulders of the distribution curve of defaults, that's precisely what the program should be doing, and not, I don't mean to sound harsh with this statement, but certainly not providing a subsidy to lenders to become careless or relax underwriting standards. The truck program is, I agree, different. So I would encourage you to think about, despite the initial appeal of the 20%, whether or not there is some kind of a hybrid approach that would be available for lenders either who are longer participants or who have managed their loss exposures differently with more stout underwriting standards. Secondly, I've already covered. Secondly, I'm intrigued personally with the idea of encouraging you and your staff to think about how CPCFA could, once the federal money and the $6 million from the state run out, to act as the clearinghouse to keep a program alive, because I think that would be incredibly useful for this community. David and I talked offline a moment ago about the importance of local lenders, whether they be a mission-based lender or a small bank or even a credit union, lending into the community, Californians lending to other Californians, and that's something that will be very near and dear to my heart and to our boss's heart. Finally, I would encourage you to think about ways in which collectively inside the building we could get better at outreach. We just heard Kevin talk about that. David and I have talked about it over the last couple of years, because what is disappointing is that sometimes we develop these kinds of really good programs, and then we can't figure out how to get them to the finish line. And I'm just wondering aloud whether or not that is because, in government, I'm allowed to say this because I'm a newcomer to government, whether in government we're talking to the wrong people. Should we be developing a target contact list of chief credit officers instead of regional managers? Should we be talking to senior loan officers instead of folks who are largely engaged in the deposit-taking side of the house? I think to the extent that we can hear feedback from the people we've heard today and the people who are sitting here on the panel to help us better understand how to get to that, then we will probably get to a better solution, whether it's 20% or the alternative approach or some hybrid of the two. I know what my personal instinct is. My personal instinct is you're probably going to end up at a hybrid, but I would leave that to you and your good staff to figure out. But thank you to the staff and to the participants today for sharing your experience with us.
Thank
you. It's easy to follow Tim because I can just say exactly what he said.
Sorry.
and also what Kevin said, and everyone else on the panel said. It's funny when Tim and I were sitting here talking. I understood a little bit about the CalCAP program. I kind of had the peripheral understanding of it. Not a lot of the detail. Not like as much as Kevin or Jeff would have on it. But as when we started communicating and whatnot, I started getting into it. I'm like, I don't know why I don't have more institutions involved in this, because it's such an amazing program. And maybe that's part of our fault. Maybe we don't. Maybe I don't promote it enough and make not light of it enough. So part of this and part of the outreach, I think that and with Kevin and the Cal bankers, that we need to get more people involved. I know a lot of institutions. I have institutions in Southern California that works closely with CDCs and other types of mission-based type of lending. There could be some neat partnerships kind of created from that thing. So my mind starts thinking about ways to, promote and take what we've taken in and see what we can do with it going forward. So I thank you for allowing me to be a part of this.
Thank you. Well, thank you. Panel members, we are at the wrap-up slide. If it wants to come. Here we go. All right. So we've come to the conclusion of this great event. A critical decision point is what drove this event. And I think having this cross-section of experts and stakeholders come together and really roll up our sleeves and talk about what makes the program special in the array of other lending tools or other resources for small businesses is a really momentous occasion that we've had. And going forward, it would be wonderful to do this more regularly, not only in crisis moments, but certainly to follow up with the good ideas that have come out here today that may not be near-term ideas because they require either further thought or research as compared to the decisions we need to make to deal with the funding flow, but certainly that need to stay actively discussed and not put on a parking lot. So that's one of my initial takeaways from today. I really appreciate everyone's active and thoughtful participation in this discussion. We know that it's critical. We know that it's not easy, and yet we have together this opportunity to take some leadership over the program and ensure that it's sustainable, to ensure that it's available to small businesses, to ensure that that lenders have the certainty that they like from these kinds of credit enhancement programs. So. With that, I do want to remind everybody, including those that participated via webinar, you have an opportunity to provide written comments to us on any topic related to the scoping document, and we would like those no later than a week from today, May 3rd at 5 p.m. It can be emailed to the CalCAP inbox, which is reflected on the current slide, or by hard copy. If it's by hard copy, we would ask that it be postmarked no later than May 3rd at 5 p.m. And we're going to be considering all the information presented today, as well as those written comments, as we prepare draft regulations for both our small business program and our ARB program, and have further discussions to develop those draft regulations. Because of the funding scenarios under both programs, we are feeling the need to be not only responsive to the need to keep the program sustainable, but to provide everybody in this room some certainty about the direction that we're going. We are aiming as a staff to have regulations published for consideration, draft regulations, no later than July 15th. 2017, and it'll be between now and then that we really can have these further discussions with all of you and see where we can come out for the best, striking the right balance for all of the dynamics that we've talked about here today. And so with that, at 1:05, we conclude our symposium. Thank you very much.